Hello, everybody, and welcome to the Investment Banking Secrets webinar. My name is Perry Fisher, and I'll be spending the next 2 hours with you guys. And as promised, we do have a surprise. We've got a former colleague of mine who was involved in investment banking, who has actually been in the financial services industry for over a decade, but on the hiring side. I know a lot of the guests in the webinar today will be some of my former students and some of my current students. And I'd say the ratio is about 50-50 between those who currently are employed and just wanted to refine their investment banking skills. But 50% of my students are either looking to move into financial services via interviewing for their first investment banking job, or transitioning in their current organization. Maybe they don't work for a bank, but they'd like to work for the treasury division of whatever company they work for. So this special guest will be joining us in probably the last half an hour of the webinar, and she'll be talking to just some of the career-related aspects of investment banking, and we will probably have a full webinar session with her because she's got great insights to share. So without further ado, I'm just going to share my screen with you guys, and we can get started. Okay, so I'd like to ask everybody to just keep their microphones muted unless I open it up to questions. I'm going to try and make this as interactive as possible. How I'd like to see this going is if you guys join the LinkedIn group, you can then post questions during the week, and then during the following webinar, I will then address those questions. So I got a very good question. I only got one question from my students. And I felt that this was actually a very good question, and that's one of the questions that I'll be covering today. I do encourage you that if I don't manage with time constraints to answer your question in a live setting now, please re-ask it in the LinkedIn group, and I've allocated a lot of time to answer one of the questions that my student posed to me. So I will do the same for you if you post it in the LinkedIn group, and we can see your question featured on the next webinar. It can be something that you are struggling with at work, or it can be something that you're just fascinated with or interested with. Just a little bit about me, my background. So I studied actuarial science as my undergraduate degree. Basically what that is, it's just the study of death and sickness, and how insurance companies use either death, sickness, or misfortune to try and make money. It sounds a bit morbid, but it is the truth. In fact, the insurance industry is quite an interesting business model if you look down deep into it, because unlike the investment banks, where you pay a deposit or you give a deposit to an investment bank and you hope to earn interest, you can withdraw that deposit. Whereas for an insurer, you're paying premiums to the insurer, and you're hoping never, ever to make a withdrawal. So whether it's insurance of your personal belongings or life insurance, you're hoping to never, ever make a withdrawal of your deposit, which is your premiums. So in that case, the insurance companies have a very long-term investment horizon, much longer than the banks do, and quite an interesting business model. So that was my undergraduate degree. But unfortunately, I didn't like that field of study. So I then went back to university and I studied financial engineering or financial mathematics. And that's the study of how to price derivatives and how to construct portfolios, risk theory. And so that was my undergrad background. I then went to work in the mining team of an investment bank in South Africa. And I spent 6 years in mining. And I did corporate financing and project financing. I was more on the debt side until 2015. And 2015, for those of you who are in the commodities space would know that 2015 was one of the biggest nosedives in commodity prices in recorded history. So we had, for instance, iron ore going from about $150 a ton to about $20 a ton in that year. So it was a big nosedive for commodities, and many of our clients went bankrupt. So then I moved more to the M&A side, but it was distressed M&A. It was trying to find somebody to bail us out of potentially sticky situations. And I spent my last years in investment banking sorting problems out. But I learned a lot more in my last few years of investment banking than I did in the first few years of investment banking. So I have got some M&A experience, but it is on the distressed side of things. And most of my expertise lies in the debt space. But I will, to the best of my ability, answer any question that you have. And if I can't get the answer, I will, to the best of my ability, source a guest, and that guest will be able to address your question on a subsequent webinar. Again, just to recheck my audio, is everything fine? Can you guys hear me okay? Just either unmute or just put a comment in the comment box. Just want to make sure that everybody can see and hear me and see my screen. Just waiting for some feedback. Okay, brilliant. I see in the comments loud and clear. Thank you very much, guys. Okay. Just something else. If you have a question and you want to leave it in the comments, can you just put all caps question and then ask your question? And if there is time, I will try my best to answer it. Otherwise, I would prefer you to unmute and ask your question, or just voice your question if you could unmute when we take questions. So let's hop in. Investment banking secrets. Okay. I am the founder of the Tauro Group, and what we do is we specialize in training solutions, and especially for people who are pivoting into financial services. Does not necessarily need to be with a bank. You can work for a hedge fund, private equity firm, and if you want training solutions, particularly in the area of deal structuring, financial modeling, that's our area of expertise. And I myself am primarily on the derivatives side and on the mining side. We will be launching some subsequent training programs that would be developed by other professionals as well, who are a lot more knowledgeable about that subject matter in other sectors of the economy than myself. But for now, our main areas of expertise are the mining sector and just general financial mathematics and financial modeling. And you can check us out at www.taurobiz.com, and that is the website address. So enough of plugging, let's hop straight in. So the first thing that we're going to cover is financial modeling. How do you build good models? So this question is primarily directed to those of us who are in the advisory space. You can work for a corporate finance firm, or you can work for an investment bank, and you have somebody with deep pockets who comes to you and says, we need advice. This is our feasibility study. These are all the technical reports that we've done, and this is a preliminary model, and we need to raise funding. We need you to develop a model for us that is fit for an investment bank or fit for whatever private equity firm that we are about to approach. And they need to do a valuation on our business to provide us with capital that we need in order to get us going. So the first question that you'd need to ask yourself if you are working in this investment bank and you now get this client coming to you is, why do you build a model in the first place? What's the purpose of doing so? If you look at this graphic on the right-hand side, it's just a word dump or word cloud of many words that people would use to describe financial models. They're chaotic, they're useless, unreasonable, cluttered, ineffective, bulky, error-filled, etc., etc. So a lot of people use modeling as a departure point to say that if Excel tells me that this is a good project, it must be a good project. And nothing could be further from the truth. Models, looking at the quote at the bottom of the slide, essentially all models are wrong, but some are useful. and that's George E.P. Box. He's a famous statistician. And why would he say that? In your personal experience, especially if you were born in the 80s, you're part of what's called the crisis generation. So you have experienced a whole number of financial crises or global economic crises in your lifetime. And so if you used models to try and predict the future, especially if you were to develop a model in 2007, for instance, or develop a model in 2019, chances are that model is not going to tell you much by way of predicting the future. So there needs to be a very well thought out process as to why you need a model in the first place in order to guide you when you're actually building a model. So why do we build models? I'm going to come back to the slide. In 2015, as I mentioned before, we saw that great commodity price crash. And what I learned on the job is that you couldn't really use modeling only as a predictive tool. You had firms in our portfolio that had good models and who had good financial departments. And you also had firms that had financial departments that left a bit to be desired and financial models that left a bit to be desired. So what was the difference between the two when that great crisis hit? If you have a good model, you can ask yourself the following three questions and you can answer the following three questions with a great deal of accuracy. What are those questions? Let's look at the first one. How long can we survive in this current environment if we adopt a business as usual approach? So your model should have sufficient granularity or sufficient detail to cover all the operational costs, capital expenditures, production profiles, and just give you a general snapshot of how your business performs in a business as usual approach. You would then need to build in certain stress testing capability in order to enable you to answer this question. So given 2015, where we saw iron ore drop to around about $30 or $20 a ton, if I was to plug that into my price deck of the model and I left all my production and cost assumptions the same, I could then get a figure that maybe we have a year in this business before we have to do something drastic. Maybe we have a year before we have to drastically change our mine plan, file for retrenchments. How long do we have for a business as usual approach before we have to do something major? The next question is, where is the low-hanging fruit internally? In other words, what can be cut now or capitalized upon now to ensure that we can weather the storm without doing any long-term damage to the company? If you have a good model and your model is sufficiently detailed, you would then have all of your major pain points in your business itemized and in a dynamic format in Excel, such that you can see that if we cut our trips to the pit by 50%, this is how much we save in fuel and labor, but this is how much we lose in revenue. Is it an optimal trade-off? If you have sufficiently detailed block models, which show the production profile, and those are typically done by your geologists and your mining engineers. And you say, if we mine pit 1 and pit 2, and we stop mining in pit 3, because pit 1 and pit 2 have high grades, therefore low cost, will that do a lot of damage to our long-term mining profile once prices recover? In other words, is it worthwhile us shutting down a pit in order to be break even during this commodity crisis? Or should we keep pit 3 going, even if it's operating at a loss itself? Because in the long term, if we shut it down and we try and open it up again, it would cause more long-term damage to the business than any benefit that it would accrue to the business. So if you have a suitably detailed model, you can also answer that question. The last question: are we actually viable as a going concern in future? And if so, is there anyone out there willing to save us if we can't save ourselves? So this is where the valuation aspect becomes very important. you need to be able to know what the value of your organization is. And you can then do some comparables. You can do what we call comps and see that, if you were to issue equity, for instance, at this stage, you value your mining company at a certain number. Is it lucrative for people to invest additional equity during this downturn? Is the mine itself a going concern? Do you need business rescue? Are you willing to shop off your organization to maybe a bigger player in the mining space? In order to answer that question, you need to have a robust financial model that can give you reasonably accurate valuations. And in order to do that, you need some accurate information in your model. So just looking at that graphic to the right, the World Economic Forum is now in the business of a great reset post-COVID. So really, if you're only relying on your models to tell what the future is going to hold for your business, I venture it as a guess as nobody really knows what's going to happen. What is this brave new world that we are living in? So it's very difficult for you to use your models solely as a predictive tool. However, it's still very important to have a good model so that you can answer those three questions. Okay, you can benchmark yourselves against your competitors, and you can know how long you can survive in this current environment, what the value of your business is, where the pain points of your business are, and where the strengths of your business are. You can only answer those questions with a robust financial model. Okay. So moving on, how do we avoid making common mistakes when building our models? Okay. How to build a good model, first of all. You need to have good process flow. So as I mentioned before, my background is in the mining industry, but this schematic will apply regardless of what industry you're in. If you are constructing a business from scratch, in other words, it's a project, you need to model in your construction costs. After the business is constructed, you then need to model your raw material inputs. Okay. The typical premise of a business is you buy raw materials low, you refine them, or you process them in whichever way that your business is involved in, and then you sell it at a profit. Okay. So then you have your input costs. Next, you have your manufacturing processes. And then you then compare your revenue with all of your direct costs. And you'd also need to consider all of your enablers. So these are your indirect costs, your head office, your management, receptionists, coffee machines, photocopiers, all of those IT, all of those indirect costs that enable the business to do what it needs to do. And after weighing up all of these processes, you'd then arrive at either a net profit or loss. So my first piece of advice for anybody who's starting on the building models journey is you want to make sure that each of these processes are on a separate worksheet or separate tab. I know some people, and some of training courses that I even attended when I was in banking suggest that as much as possible, you have as much as possible on a single tab. But whenever I've received models like that, and you are scrolling down to row 1333, and it references row 32, and you have to scroll all the way back up, and then that takes you to row 539, it's just cumbersome. So what I've found is if you can compartmentalize every single key step in your business into these compartments, please keep every single compartment on a separate tab. It just makes debugging the model and going through the model a whole lot simpler. And you yourself, when you're building a model, it also makes your life a whole lot easier because it's almost as though you can focus better. Okay, today I'm just going to build in my CapEx and my construction assumptions. So you just focus on that for the day. And then when you're done with that in 3 months' time, then you link everything, build in your stress tests, and you can give that to the client. Okay, so that's my first tip. Have all of this on a separate tab to the best of your ability. Have your raw material inputs feed from a single tab, and these would typically be hard-coded numbers. And you'd also need some hard-coded numbers for your manufacturing processes. And I'll show you an example. So I have a model here that I use for my mining finance and my financial modeling course. And I have all of my economic assumptions on one tab, and these assumptions feed through to every single one of the tabs in my model subsequently. So my mining assumptions tab is only for mining assumptions, where I model the round trip distance from my crusher to my pits. I model the number of trucks, the average rock capacity. That's only mining. I have a tab that's only plant, a tab that's only labor, your salary grade, et cetera, and a tab that's only capital expenditure. So it helps to keep everything neat and tidy. And you'll thank me later if you do it this way, as opposed to having as much as possible on a single tab. Okay. The next tip is avoid long formulae in a cell. Avoid nested loops and ifs if possible. I'm going to pause here and I'm going to open it for questions. Let's give 5 minutes to any questions, any quick questions that you might have so far. Do we have any questions in the room? Let me also just check the chat. Okay, no questions so far. Okay, so let's do an example of avoiding long formulae in a cell and avoiding nested if statements and loops. Loops applies if you're using something like Visual Basic, but we'll just show what a nested if statement is. I prepared this short example. You have, this is just a general year counter, 20x1 up until 20x5. So it's a 5-year model that we're working with. And we've got this company that is modeled in the dollars millions. So quite a big company. It's making $1 billion in year one, and that's growing steadily over time. And these are its costs. And it has, after you subtract all your costs for revenue, this is the amount of money that the firm has left over to pay its debt. We call this cash flow available for debt service, or CFADS, as an acronym that you'll hear very commonly in the debt space if you're involved in debt. Let's say that this firm has got senior debt. So it's got bonds, it's got amortizing facilities, and the total interest and capital burden is given by this schedule. Let's assume that it's amortizing, so the interest burden goes down over time, but it's still repaying capital on senior debt. So let me just stop there. Senior debt is the debt that is paid first. It gets the first bite of the apple, if you will. So if you have a company that's got numerous debt facilities in place, you then in your legal agreements, you'd need to stipulate who gets paid first, who get paid second, third, fourth, and so forth and so forth. So we call lenders that have the first claim to the cash flows senior lenders. You then have subordinated lenders, which only get paid if your senior lenders are paid in full. So in other words, if a senior lender needed to be paid $150 million in that year, but the company didn't generate sufficient cash in order to pay that $150 million, then your mezzanine lenders would not get paid at all, because there would be a shortfall in the amount that was owed to the senior lenders. Okay, so only if the senior lenders are repaid their full $150 million in interest and capital in that year, can the mezzanine lenders hope to get some interest or some capital payment after the senior lenders have been paid. So let's assume that we are now subordinated lenders. We're now lending a mezzanine facility, which is a facility that kind of behaves like debt, but it also has some characteristics of equity. So we have this mezzanine facility. And we have got an opening balance. We've got our drawdowns. Have an interest expense. We have the interest that we're actually paid. And then we have something that's called a cash sweep. So typically for these mezzanine facilities, you don't have a contractual amortization profile, meaning that there's no fixed schedule that tells you have to pay $50 million in quarter one, another 10 million in quarter two. It's not contractual. You pay via a cash sweep. So the mezzanine lenders say, whatever cash is left over in the business after you've serviced all the senior lenders, we're going to take a percentage of that cash to repay the debt. And that's what's called a cash sweep. And let's assume for this example that we will take a third of all the cash that's left over in the business to repay the capital on this mezzanine facility. And then we can then have a closing balance. So let's assume that this mezzanine facility was $500 million. Okay. We started with zero and we drew down $500 million at the beginning of the year. Our interest, let's assume that it's reasonably priced, 15% rate of interest on this mezzanine facility per annum. And so the interest that you incur during a given year will just simply be the amount that you've borrowed, the opening balance plus your drawdowns, and you'd multiply that with the interest rate for the year. So that's the interest expense. Now, this mezzanine facility has got no default rights, so we'll get paid if there's money. Basically, that's the situation here. So how do we model that? We can then say, we can put an if statement here, and we can say that if there's cash after senior debt, in other words, if this is a positive balance, we want to get paid the smaller of whatever interest is owed to us, okay, and what you have to pay. So the interest that is owed to us in this year is $75 million. But if you only have 20, we'll take the 20. Okay. So to express that in the form of a formula, I'm going to use a min function. We're going to take the smaller of whatever cash you have available and whatever you owe us for the year. Okay. I'm going to make that negative because that's money that is going to be flowing out of the organization. And I'm just going to drag that across. I will fix it. Next, we move on to this cash sweep. I'm going to apply similar logic for that cash sweep. I'm only going to sweep if there's money. If there's no money, I can't call default. There's nothing I can do. So I would say that if there's money after you service the interest, okay, if there's money left after you've serviced the senior debt and after you've paid us the interest, only if there's money left over, I want to take 33% of that money to repay the capital outstanding. Okay, so I will say if there's money left over, I'll rather put that if it's positive, the money that's left over, then I will then take whatever money is left over, which is given by that result, and I'll take 33% of that money that is left over as my cash sweep. Okay. But now I also think of some possible scenarios, okay? What happens in a year where this cash sweep would exceed the amount of debt that is owed to us? I can't take more from this company than they owe me. So if they only owe me, for instance, $100 million, but the cash sweep says I'm entitled to $156 million, I can only take $100 million because that's what they owe me. So I need to cap this formula, okay? So what I can then do is I can put another if statement there. I can say if the value of my debt outstanding, which is simply your opening balance, your drawdowns, any interest incurred, and any shortfall. So I'm just going to include all of that. If the debt that I owe, okay, is greater than the value of the actual cash sweep, and what is the cash sweep? It's just whatever I have in the business minus what I've already paid in interest, and I'm going to take 33% of that. Okay, so if the amount I owe is more than the value of the sweep, then I'm going to apply the sweep, which is what the remainder of that formula in the brackets is. However, if the amount I owe is less than that, in other words, if this if statement is false, I'm only going to sweep the amount that I owe, okay, or the amount that is owed to me if I'm the lender. And the amount that is owed to me is just simply opening balance, drawdown, interest expense, and the actual interest paid. Okay. And that is the if statement that explains my cash sweep. I'll just drag that across. My closing balance will just be the sum of everything that's happened in that year. And then my opening balance will just be the closing balance of the previous year. And drag that across. You can drag that across. Okay. And interest expense, drag that across as well. Okay. So what I find is that with a cash sweep, I will repay this facility in year 3. But if you look at this formula, wow, it's got some nested ifs there. And if you were to look at this formula like this, it's pretty complex. Something even worse happens if you're trying to calculate royalty payments in the mining industry. You have a lot of nested if statements because they're different levels of royalties depending on how well the company is doing. So there must be another way to do this. Let's see if we can make it a bit more efficient. I'm going to just change the way I calculate these lines here. Okay. The interest expense. My interest expense, I know I can only take a maximum amount. Okay, so the interest expense is just what it was before. It's just going to be 15%. Just do that quick. 15% of whatever was outstanding. So that's fine. The actual interest that I pay is limited by how much cash is in this business. So I can't take more than the cash that is in the business. If the business has no money, I get 0 interest paid. So instead of using an if statement, I can just say the interest that's going to be paid to me is the smaller of whatever is owed to me and how much cash is actually in the business. Just a simple min function. Okay, I'm going to take the smaller of what's owed to me and what is in the business. If the business only had $10 million, I'd take the smaller of those two numbers, and I can only take $10 million to pay my interest. So that's easy, a lot shorter than that formula with an if statement. I also need to protect myself to idiot-proof the model. What happens if they have a year of negative cash flow? Okay, I can just simply prohibit this value from ever being a negative number by just putting in a max function. It's going to be the maximum of whatever that value is and 0. The max function just ensures that I'll never ever get a negative result here. So I can then drag that across. Okay. And then let's do the cash sweep again. And let's use a similar reasoning. I know that the cash sweep is going to be the smaller of however much money is in the business and however much is owed to me as a lender. So I can use a min function again. The cash sweep is going to be the smaller of however much money is left in the business, which is the cash flow after senior debt, subtract whatever you've already paid in interest, that's how much is left over, and then you sweep 33% of that. Okay, I'm going to take the smaller of that and the amount that is actually outstanding in debt. And the amount that is actually outstanding in debt is just the sum of your opening balance, your drawdowns, and the net interest for that period. It would be 0 if you manage to pay all the interest. Okay, and that is my formula there. And what I can then do is make it a negative number because that money is flowing out of the organization. Just compare that formula with the formula with the nested if statements. A lot more efficient. Again, I have to idiot-proof the model. So I have to make sure that in a year where we have negative cash flow, you're sweeping 0. So I just put maximum of that result and 0. I can drag that across. And we have exactly the same result, but much more efficient. So if you are debugging a client's model, you hope and pray that the client has been efficient with their formulae, so that if you have only a week to understand the model, you're looking at formulae like this, as opposed to formulae that sometimes go for 3 lines with nested if statements. Okay, so To close off that one, avoid long formulae in a cell, avoid nested loops and if statements. Color coding and consistency. It's very useful if you adopt a color coding in your models. So you can say that whenever a cell is a certain color, it's going to be a hard-coded number. So for instance, all of these numbers, it's a certain color. The cell is this beigey sort of gray color. It means that it's a hard-coded number. Whenever it's clear, it's a formula. And the last color code, whenever it's a silver color, it's an actual result. Okay. And then a sensitivity will be bright red with a yellow background. So color coding, it really does help when you are navigating your way through a model to understand where the hard-coded numbers are. So that's also a time saver in the future. Might take you long to put the model together, but in the future when you're debugging, that's an excellent tip. Always pull assumptions from a single sheet if possible. Other than where hard-coded numbers refer to specific processes. So I just went through that. I'll just repeat myself. So try and have all of your hard-coded assumptions, such as inflation, pull from a single tab. Instead of your operations tab, you put in your assumptions for your exchange rate. Rather pull it from one place. And then you can reference it here, then have hard-coded numbers floating around in this tab, in this tab, in this tab. Try and minimize that. However, hard-coded numbers such as the salary of a technician, I wouldn't put that on my economic assumptions. It's best for me to put that where it's relevant. So I have as little as possible hard-coded numbers in other tabs, but the few that I do have are important to those tabs. So I'm not going to put all the salaries on this tab. Otherwise, again, I'd run into the same problem where this tab has got 600 rows of all the assumptions in the model. This is a lot more efficient. It's short and sweet, to the point. Only 88 rows, and I know who's employed in this mine, and I've got their salaries, as opposed to try and putting these 88 rows below these ones here. Okay. And the last one, build in row totals and error checks. Gold. Important. Yes. Do this. Row totals. It's just common sense checks, and they really help you. So like if you want to work out the cash cost for this mine, over its life of mine, you've got the total of all the ore that's mined, and then you can just get the total of all the revenue, for example, just off the top of my head. These row totals are really useful as well if you want to check for errors. If you know that, I can't think of any right now, let's say you've got the average exchange rate for the year, and you multiply the average exchange rate of a life of mine by or divide the average revenue or the total revenue of a life of mine by the average exchange rate. You can check that with another row that's just got your revenue quoted in another currency. So I can't make these examples up off the top of my head, but trust me on this one. These row totals and error checks really do help. Yeah. Okay. So that's the first section done. I'm going to open it up again for any questions. Does anybody have any questions? You can just unmute. I'm going to check the chat again if there are any questions in the chat. Remember, if you're asking a question, just put all caps question. It helps me to scan quickly. Okay. Sure, no questions? Okay, we'll continue. Maybe you'll get more questions in the next section. So this section was actually a very good question that I got from one of my students. He was asking, how on earth do you estimate cost of capital in the mining sector? So let's start with just a background. The cost of capital is, let's just read what's on the slide. Cost of capital is used to determine the optimal mix of debt and equity funding to a firm and to perform valuations on the firm. Basically, what your cost of capital is, it's just a measure of the financial efficiency of your firm. Okay. If your firm is being run via credit cards, for instance, The cost of applying $1 in your firm is very high. Contrast that to a business that is now a recipient of this US Fed government bailout money and cheap interest rates. The cost of applying $1 in that business to get a profit is far less than a business that's using a credit card to fund the operations. Because there's a lot of inefficiency, there's a lot of wastage that goes into that dollar. So $1 comes into the organization, and hopefully if you're doing something right, $1 comes in, $2 comes out. Now, how efficient is that $1? If it's very expensive for you to acquire that dollar, it means that your firm is not necessarily that financially efficient. So what you want to do is you want to reduce your cost of capital down to a minimum. You want to get these cheap dollars flowing into your organization, and then you will maximize your profit. Okay, so that's on an intuitive level. You would also use this cost of capital to determine the optimal mix of debt and equity funding for your firm. This means that in a situation where debt is cheap, such as the market today, you would want an organization that has a balance sheet or capital structure that has got a lot of debt relative to the amount of equity that's issued in the market. And this creates a perverse incentive, as we shall soon see. Okay. Let's look at an application of your cost of capital. We use weighted average cost of capital in textbooks. If you look at the NASDAQ, now the NASDAQ is just an index, a NASDAQ 100 is the top 100 firms in the US, and it's weighted according to those firms' value. So it's just an index, and when the index goes up, it means the value, relative value of those 100 companies has gone up in share terms, not necessarily in productivity terms. This is the biggest thing, and certain presidential candidates will harp on about the US economy being the best that it's ever been. In share terms, yes, but not in actual productivity terms. Okay. So let's look at what happened in the global financial crisis of 2008. Okay. You have this dip in the NASDAQ. Obviously, there's less money floating around in the economy. People spend less. So the value of those firms, people look at it and speculators look at it and they say, okay, maybe the outlook isn't so great. So the value of the shares, remember, shares are forward looking. When you value a company, you're looking forward. Their idea is that these firms are not going to be doing as good. And that was the case. Many people did lose their jobs, and some of this was true. But what starts to happen in 2009 is we see the effect of these government bailouts. So the Fed starts printing cash, and it guarantees the debt of these large corporations, the top 100 corporations. Basically, what the Fed steps in and says is that if you have debt outstanding, we're not going to pay the debt off, but if you can't pay your debt, then we will step in and we will pay the debt for you. So it's like a guarantee, okay? Another thing that the Fed does, it says, okay, we need to reduce interest rates in the economy in order to encourage spending. So if there's low interest rates from an average man or woman on the street, you're paying less on your debt. So that means you'll have more disposable income to spend in the economy. It also means that these firms will be incentivized to borrow more money, to build more factories, et cetera, et cetera. So you could say that they had good intentions. So they issue cheap debt, they lower interest rates, okay? So there's now cheap debt in the market, and they also guarantee the liabilities of these organizations. This is a no-brainer. If you can borrow money, debt, and you know the government's going to stand behind you, no matter how much you borrow, okay? They're going to stand behind you and issue a guarantee that says, if you can't pay your debt, we'll pay it for you. And if debt is really cheap, what do you think you're going to do? You're going to borrow as much as you possibly can, okay? So what do we do with all of this money? We don't know. We don't have any bright plans to build new factories. We don't really believe that the world has recovered. So our outlook on the world isn't that great, but let's just get the money anyway. So that's what they did. They took as much debt as they possibly could. And if you look at the weighted average cost of capital calculation, It's a weighted average of your cost of equity and your cost of debt. We'll go more into the formula a bit later. But you can reduce your cost of capital if debt is cheap. All you need to do is you need to increase the amount of debt you have on your balance sheet. In other words, increase this weighting. So you have more debt on your balance sheet. Now, the rate of that debt is low. Okay. The rate of equity is higher than the rate of the debt. Because you've shifted more towards debt, you've shifted less towards equity. And because you've done that, your cost of capital comes down. So your firm is more financially efficient. The dollar that you've raised in the market is costing you less, and it means more profit to you and your shareholders. So I don't blame the executives at these top 100 companies for doing this. But what they would then do is they would take on all of this debt, and then they'd reduce the value of equity in the market. How do you do that? You buy back your own shares in the market. So I'm a company, I'll raise $100 million of debt, and I'll apply most of that money to buy my shares back in the open market. This has two effects. It drives up my company's share price. Remember, I haven't built that new factory. I'm not producing anymore. But my share price has gone up. There are few of my shares in circulation. Okay, less shares, it means the pie, which is my company, is divided up into fewer slices. And because of that, each slice gets bigger. In other words, each share increases in value. And that's what we saw from the global financial crisis of 2008, the US stimulus, all the way, the longest bull run in recorded history, up until a trade war that was started in 2018. Again, the market gets jitters. They realize that it's a little bit harder to import cheap Chinese goods. So, wow, maybe the profitability outlook for these top 100 firms is not as rosy as it once was. So then you have a slight dip in the NASDAQ, ending this 10 or so year bull run. Okay. I just want you to pause and think of this for a second. The stock market is going up. However, productivity in the economy and the actual health of the economy is not. It's an optical increase in your share price and in the economy if you use the stock market as a proxy for the health of your economy, which you should not do. Okay. Now, the US Fed promises again low interest rates because there were some rumors here that interest rates were going up because the Fed started hiking rates. So they start lowering interest rates again, and hunky-dory firms carry on borrowing and they continue with the same behavior. And then we have something interesting happening at the beginning of 2020 with COVID-19. Everybody forced to stay at home and a lot of people losing their jobs. Again, this does not bode well for the economy. So you see a dip in the NASDAQ. But then what do you see immediately after? You see the Fed printing money, trillions of dollars on a daily basis, and you have the same cycle over and over again. So that's why I'm saying that it can create a perverse incentive, but this is just one application of why you should know what your firm's average cost of capital is. Because if it's cheaper for your firm to be predominantly debt-based, then why not? If you're a treasurer or chief executive officer at a big corporation, your shareholders will be actually angry for you for not taking the money. And your shareholders will be very happy about these share buybacks because they get money in their pocket at a price that's higher than the current value of their shares. Okay, so that's just an application of the weighted average cost of capital. But going back to my student's question, how do we do this for the mining sector? So that was just a bit of introduction as to what the weighted average cost of capital is and how you use it. So the cost of debt is easy. It's just the weighted average of all the interest rates across all of your debt facilities. Important, your long-term debt facilities. Okay, so you have a company that has got bonds, amortizing facilities, a whole host of long-term debt. You take the weighted average of all of that debt, and then you get your cost of debt. which is then this RD number there. Okay. Your cost of equity is just estimated relative to traded instruments in the market. So your cost of equity is just the risk-free rate. It's just the rate on a long-term government bond, usually, times by your beta, which is a factor, a sensitivity factor. It just expresses how sensitive your individual firm is to movements in the general market. Okay, so a beta of 1, if the general market or general economy is growing at 10% per annum and your company has a beta of 1, it means that your company will also grow at 10% per annum. If the global economy is dropping by 20% per annum and your company has a beta of 1, it means your company will drop by 20% per annum. It follows the general market. It's perfectly correlated. Okay. Things like gold usually have a slightly inverted beta. And that as well, with all the noise that's happening in the world today, it's subjective, but theoretically, gold is an asset with a negative beta, meaning that if the economy is doing well, the gold price generally decreases because gold is seen as a safe haven investment. And if the economy is doing very badly or there's high inflation, then people typically invest in gold. Okay. And then after you do the cost of equity, you can also add some adjustment factors. So this is the first part of me actually answering this question. You'd apply your CAPM formula as per normal, and you'd have adjustment factors which are individual to your bank or to your advisory firm. The ones that I've heard thrown about the bank when I was there is you add a 1% premium if it's a brownfields mining expansion. A brownfields mining expansion is you've got the mine there, it's operating perfectly. You just want to increase the output of the mine. So if there's some expansion project involved and you want to value the mine, you would then add 1% to your cost of equity if the mine is already producing, and 2% if it's greenfield. In other words, if you're just constructing this mine and you want to do a valuation, whatever this result comes out, your cost of equity, you add 2%. Okay. I don't know where those numbers came from, but they were used and they were just generally accepted in the industry. So you'd have to check with your individual firms what the adjustment factors they use there, and they could have very scientific adjustment factors that you'd use for the mining industry. But as a start, you can just apply general CAPM formula, add a 1% premium for brownfields expansion or 2% for greenfields expansion. If there's no expansion, then you can just apply the CAPM formula as is. Okay. Now, how do you actually estimate these variables? So the risk-free rate is just a traded government bond. You can get that very easily from Reuters or Bloomberg. The beta is actually easy to estimate. You just take your historical returns of the company. Okay. Returns is just the difference between the share price yesterday and the difference between the share price today, whether positive or negative. And you take a long enough history. So you look back. There is a lot of argument as to whether you should use historical data, because given us being part of the crisis generation, the past 5 years, with everything that's happening with the World Economic Forum's Great Reset, you don't really know if the world will be the same going forward. So whether you can use historical data is anybody's guess at this point in time. But it's relatively easy if you want to do it by the book and how most people and most practitioners do it in the market. You just take a relevant enough history and you calculate the covariance of, or just covariance is like the nature and the size of the variability between your individual share and the market. Okay, divide that by your variance and it gives you a correlation coefficient, which is your beta. Okay, so this is actually easy to estimate using historical data. The trick is, how do you, and this is historical market return, okay, for this beta calculation. The trick is here, how do you calculate this market return in the formula here? You can do it backward looking. You can use the same data set you used for your beta, or the historical price movements of an index. So in South Africa, we have the JSE Top 40, which is used as a proxy for the entire economy. It's the top 40 companies on our stock exchange. You can use the S&P 500, you can use the NASDAQ 100, just an index that pretty much summarizes the entire economy. You can use historical data for that to estimate what your market return. You can find an average of what it was historically. The problem is, how far back do you go? Do you go back 100 years to smooth out any of those irregularities? Do you go back 1 year? Because now we've been living under this brave new world for, call it a year now. So maybe 1 year is a good estimate. But having said that, there's a lot of volatility in 1 year. So what period do you take? That's an open question. You can also do a forward-looking calculation of your market return. And this is done, I saw a professor at NYU do this, and I thought it was quite intelligent. What he does is he takes the value of the index. So let's say we've got the value of the NASDAQ over here. Let's assume that we're doing the valuation. We go back in time and we're in 2008 and we want to calculate what the expected market return will be in the future. You take the value of the NASDAQ at today's date, which is 2008. And then you'll have a bunch of analysts that will say, we predict that the NASDAQ will rise 2% year on year, okay, for the next 5 years. And thereafter, it's anybody's guess. But then you have the World Bank and you have other sources of information that predict that your country's economy will grow at 1%, if it's the US, 1% per annum thereafter. So what you can then do is you can inflate the NASDAQ at 2% year on year for the next 5 years, according to industry consensus. And then after year 5, you can inflate it at whatever your economy of the country that you live in will be growing at. You then take all the dividends or assumed dividend yield or dividend payouts of the next 5 years on this index, and you simply value it the way you'd value a bond. You take the dividend payments of every single year, and you take a terminal value, okay? Those of you who've done M&A work, you take a terminal value, and the terminal value, you can just use the growth rate of what the World Economic or World Bank estimates your economy will grow at in the 10 to 20, 30-year future. You can use that to find your terminal value, and then you would discount it at a rate that makes the value of the index today equal to the value of all the dividends that you'll earn and the present value of your terminal value. So that's a forward-looking market risk, rate of return. I just see some questions. Let me just finish the point and then I'll answer the questions. Okay. So yeah, the forward-looking method involves a DCF method, almost like valuing a bond. Equate the price of the index today to the present value of consensus forward-looking dividends and consensus forward growth rate of the index. The rate that satisfies this equation is the market rate of return. Okay, so just doing that, that's how you'd calculate cost of capital in the mining industry. I just want to take the question even further. In the mining industry, you have certain stages. Okay, before I go on, I saw some questions in the chat. Let me just see. How do you achieve your optimal capital holding, i.e. the proportion between equity and debt? Holding too much of either instrument has devastating effects on profitability. Oh, very good question. Okay. Wow. Optimal, define optimal. If you are a mining startup, it's optimal that you have zero debt, my friend. So define what optimal is. You can do some mathematics to solve for your maximized return on equity. If you look at the formula here, let's just go back to this one. If you look at the formula here, you have the market value of equity. right? Just stay with me here. We're going to just bounce a lot of variables up in the air. If you have a lot of shares in issue, so you have a company that's funded entirely by means of equity, okay? Potential investors on the stock exchange see this company as very lowly geared. In other words, your management team lacks dynamism. So that's going to depress your share price. Okay. A depressed share price, stay with me here, a low share price increases your cost of equity. Okay. You want to entice people to buy your shares, so you have to incentivize them to buy your shares. You have to make up for it somehow. Okay. So you have to promise them higher dividends. Okay. So if you have a firm that's weighted entirely through equity, your shareholders will only be happy with you if you are generating a lot of dividends in your company. You're making them happy. Okay. If you're a low dividend paying share, but you've got a lot of leverage in your firm or your shareholders see that as you are borrowing money in the market at a lower rate than the cost of equity. The higher you gear a company, the higher the return, everything remaining constant, the higher the rate of return for your equity holders, because the more you gear a company, the more the leverage of that company. So, yeah, I mean, to put all of those variables together, it depends on what is optimal for you. If it's optimal for you to have a robust company, it's in a mature environment, then you might want to retire some debt, especially if your mine is nearing the end of its life. It would be optimal for you to have less debt on your balance sheet and more equity. If you're in the mining space, you can't gear as much as companies in the retail space because of the cyclicality. So optimal, from me, I was in the debt space. Optimal to me is very different to optimal for somebody who's in the private equity space that wants to maximize their returns. For me, optimal is it a robust capital structure that will survive seasonality? And there, the optimal debt equity mix, the industry precedents like a 60-40 debt to equity. And there's also whatever your financial covenants are on your debt. Basically, I would take my cue from the financial model. If your company, how we calculate debt capacities, we look at the model. And if the company shows that there's too much leverage or too much debt, then it's not optimal, even if you are returning record rates of return to your shareholders. At the end of the day, a bank is not going to be happy to lend you money. Okay, take a last question. Do you use unlevered beta or levered beta when calculating CAPM? Does this depend on whether the company is trading? Wow, now I'm going to have to go back on this one. Can I park that question for the next webinar? So, wow. You need to take into consideration, just on a conceptual level, you need to take into consideration what whether the company's listed or not. I think that's the main argument for levered versus unlevered beta, because if you're looking at companies that are listed, they have all of that information available, and that's reflected in the share price. And then you'd have to subtract the effect of that debt. And then if you've got a private company, you'd need to adjust the beta for listed companies to make it an unlevered beta. I'm just going through the theory in my mind. But I think this is a question that I'm going to have to chew on. Can I save this for the next webinar, if you don't mind? Because I don't think I'd do it justice in 1 minute. It's a good question. Okay, next webinar, noted. Okay, so looking at this thing, the mining life cycle has got stage 1, which is just your exploration. Stage 2 is where you're doing your feasibility studies. So you're proving up your reserves, okay, from your resources. And then you actually start building the mine. You order the heavy equipment and you start constructing the mine, and you ramp up your production. And then you reach steady state production at stage 4, and stage 5, you're winding it down. Okay, so these are some alternative methods of valuation. DCF is not the only method. You have certain mining codes. In South Africa, we use SAMVAL. We use SAMREC to classify reserves or resources. And then we have SAM-VAL, which is a code that governs how we value mining companies. And there are actually three approaches to use. It's not all DCF. You can use the income approach, which is the DCF methodology. You can use the market approach, which is use comparable companies and recent transactions, or comps in corporate finance jargon. And you would then use those comps to arrive at a net present value per unit of metal. And then you can also use the cost approach, which is the amount of capital that's been spent to date on this project, minus any degradation or any adverse things that have happened to the deposit. If any of the deposit has been used up, that's degradation as well. So it's like depreciation, if you will, or any adverse thing that has happened to this deposit. Okay. And then you'd add the costs required in order to verify the asset characteristics. Okay, and that's a cost approach. Another cost approach is just to look at the market cap of the company. So there are three approaches that you use to value a mining company, not just DCF. And this table is taken from SAM-VAL codes. And let's just run through it quickly. If a mining company is early stage exploration, you won't use a DCF valuation because you don't know anything about the deposit. You haven't proved up reserves yet. You don't know enough to place any reliance on your future cash flows in that discounted cash flow valuation. So generally not used. If you're an exploration company, you could use comps, okay, widely used. Let's say you've got a deposit right next door. I know we did this. There was a project that was still in the early phases, and somebody wanted to buy it. And so we looked at a neighboring deposit, and we looked at what was paid by the majority shareholders of that neighboring deposit. And then we assigned a value per ounce or per ton of mineral in the ground. And that's what we used to value the deposit next door. So you can use it, but very subjective, and not, I wouldn't take a project in Africa and compare it to a project in Chile, for example. You have to compare like for like. So it works very well if the deposits are next to each other, and if the characteristics are very similar. So Chile, let's say copper, lower grades than say a copper mine in Zambia, but maybe Chile political risk is lower than Zambia. So, all of these factors will play off against each other. So you need to be very careful when you do this. And then for early stage, you'd use the cost approach. This just makes common sense. So if somebody has spent $1 million to do drilling, okay, and what's the value of what they've done so far? You could say, okay, you spent $1 million and they just want to sell it, so I'll give you $1 million for it. Okay. Or if it's a very promising deposit, I've spent $1 million in it and I want $2 million because this deposit is just the best thing ever. So this is very good for early stage exploration. And then you can see as things progress, I'll leave a link to the SAM-VAL. I'll leave a link to the SAM-VAL guidelines in the LinkedIn group. And you can see that advanced stage, development, production properties, dormant properties. This is what happened in 2015. So the mine needed to shut down because it was just not profitable. And there you can see how you'd value that asset if you want to sell off that mine. If it's economically viable, economically not viable, and defunct. So, I mean, that's like at the end of its life, or some tragedy happened and you just can't mine it. Many of South Africa's mines today are very deep level mines. There's still gold there. It's just, we haven't got the technology to go 2-3 kilometers down into the Earth's crust and mine it safely and profitably. So we just closed that mine down, but there's still ore there. Okay, so that should answer the second question. Are there any more questions? I have, Raphael, I've noted your question, and that will be covered in the next webinar. So thank you very much for the good question. If you have any questions, let's say preferably on what we've covered so far, because those I can answer quick. Okay. Last but not least, okay, credit analysis, context and opportunity cost. So the last section that we're going to go through today is also, it's related to a question that I got asked by a student, because I recently updated one of my courses and I included a chapter on credit analysis. And my student just wanted an idea of how to do a credit paper, or if you're in private equity or principal investments, how to do an investment thesis. What's the best format of it? And I'm going to give you some tips. Okay. When you're analyzing financials, start vertically. So let's look at this income statement. Okay, this is taken from a fictitious example in my mining finance course. You have this copper mine, and you can scan it vertically to see what the material items are. So it's making $2.7 billion of revenue in copper. Okay, you can immediately scan that to see gold as a fraction of that. Maybe gold is what? Oh, it's a seventh of that. Okay, whatever that works out to be in decimal numbers. So you can immediately see that a bulk of the revenue comes from copper, and let's say roughly 13% comes from gold and 87% comes from copper. And then you can then look at, I think I just made a mistake there, but I'll just fix that later. You can then look at what your operating costs are and which are the material costs. I wonder what I did there, but anyway, I'll fix that later. Sorry, going back. You can see that whatever cost this was, it's not that material in the bigger scheme of things, but your operating, okay, what I'm going to do is I'm just going to go back to the model because this is where it comes from. I think I made a mistake somewhere. Okay, and just go back to this income statement. Okay, there we go. So you have your fixed costs and you have your variable costs, okay? And we can see that from a materiality standpoint, especially when you get to steady state levels in 2025 onwards, your variable cost for your plant, wow, and your variable cost for your mining are actually material items, okay? As opposed to your fixed cost for your mining and your fixed cost for your plant, which are non-material items. Now, typically when you're doing financial statements analysis, they would have notes to this in the company prospectus or in the annual financial results, and they break down what those variable costs and fixed costs exactly are. So let's just look at this business. So this was your mining fixed costs, and this is your plant fixed costs and your mining variable costs. So you look at this business vertically and you can say, okay, the first thing that I can think of, this is a good thing. The business has low fixed costs. This means that the business has got operational flexibility. And you write down in your paper that fixed costs are a low proportion of total cost of sales. Okay. This means that if the business needed to cut down on its production, it's got more freedom to do so. Because if you think about the converse, if a business has got high fixed costs, it means that this business can't cut production, because if it does, those costs are going to be incurred regardless. But if you have a business with high variable costs and low fixed costs, it means that when it cuts production, costs are going to go down almost commensurately. Okay, so that's the first thing that you'd just note to self, put that down. High variable costs in relation to fixed costs. Good thing. Okay. Going back down, going vertically again, you see your operating profit margin quite high. Okay. In the mining sector, you need these high margins because it's a very capital intensive sector. So it's not amazing, but it's pretty decent. You then see your total general and admin realization costs, not such a material number in the grand scheme of things. So you think to yourself, okay, the numbers that I should pay very close attention to are my variable cost in mining and my variable cost in the plant. I need to really drill deep and understand these line items because they are quite material. Okay. And finishing this, yeah, these taxes and royalties, you can't really do anything about that. Your depreciation expense is what it is. So you already have your material line items that you need to drill deeper. Next, then you move horizontally. What are the trends? Okay, so I just did it here. You can see revenue growth, 6% year on year for the 3 years historically. Now, this is where things start to get a little bit more interesting. Is that a good thing or a bad thing? Okay. In South Africa, inflation is supposed to be between 3 and 6%. So if you put it in that context, maybe this company isn't doing so great. Maybe it's stagnating. Okay. You then have to also drill into what's driving this increase in revenue. Is it driven by an increase in commodity prices, or is it driven by an increase in output? Okay. I can tell you now from the course that this mine has already peaked in production. So these increases in revenue are driven primarily on commodity price increases. So maybe from that standpoint, the revenue growth is flat actually in real terms. It's not necessarily growing in real terms. So you're not making any more money in real terms. So once you put it in that context, it changes the picture quite dramatically. Another thing that you can do is you can put it in the context of its competitors. If the competitors in the sector are growing at 10% year on year, then these guys are slacking. They're lagging behind their competitors. Somebody's stealing somebody's lunch. Somebody's taking market share. Okay. If your competitors are growing faster than you, it's only a matter of time before they overtake you and start stealing your lunch. So put it in that context, maybe they're not doing that well. However, if we swap it around and we say that no, their competitors are actually doing the same, okay, changes the view. If their competitors are doing worse, changes the view completely. So the number one point I'm going to drive home here is don't just state the trend. Okay, very important. When you're doing your credit or your investment paper, don't just say 6% year-on-year growth in revenue. What does it mean? Okay, what are the competitors doing? What is the industry doing? Okay, so you always have to put it, the word here, put it in context. Very important. So that's the first tip there when we're moving horizontally. You can also look at these operating profit margins. They seem to be getting better with time. Okay. And that is because your expenses are coming down or your expenses are remaining relatively flat. You've got this increase in your revenue and you've got more or less flat costs. So that's a good thing. Your margins are improving over time. Again, in context. In the industry, if you think about where gold is right now, around the $2,000 mark, and all-in sustaining cash costs between 1,000 and 1,200. I mean, those are some nice margins. So if this was a gold counter, maybe they are, let's see, what margin is that? That's about 800 divided by, that's about 40%. Okay. So let's say this is a gold mining company. They're more or less in line with where the sector is. But let's say that in the industry, the competitors are doing operating profit margins of 60%, okay, then you'd say that these guys are inefficient in their operations. Their cost structure is inefficient. They are too expensive an operator. And when things go pear-shaped, they're going to go out of business first. So maybe it's not a worthwhile investment. So you have to take everything in context. Okay. And the next point, okay, then put everything in context. What is the industry, or what are the competitors doing? Because we answered 2 in 1. The last thing that you need to do, and this is the cherry on top that'll make your bosses, your credit committee or your investment committee super happy with you. If you really want to impress, then you dwell on this point, the opportunity cost. Okay. So in this context, this credit paper is given in the form of a debt financing. So this company wanted to raise debt, and we put together a credit paper motivating whether we should give it the, I think it was about $1.5 billion of debt that they wanted. Okay. Now, in order to really impress at work, you would then say, okay, this company is applying for $1.5 billion of debt, but this company also has some bonds that are trading in the market. What's the yield on those bonds? Okay. In the example here, the interest rate on the debt was 4% over LIBOR. Okay, LIBOR is practically 0. So let's say you're getting an all-in of 4% on this company, but in the bond market, senior unsecured debt of this company is trading at a 6% coupon. Okay, or let's say an all-in yield, not a 6% coupon. Let's say an all-in yield to maturity of 6%. So this company also wanted unsecured senior debt, but they wanted it at 4%. Why don't you just buy the bond and get a 6% yield as opposed to investing in this senior debt at 4%? Okay, what's the opportunity cost? You can refine your thinking even more. So the bonds are trading at a yield to maturity of 6%, but the debt is secured. Okay, so I think the value of that security package is worthwhile. So I think the opportunity cost of not investing in the bonds are unsecured, but investing in the debt is secured. The opportunity cost is I give up 2% yield. However, I also give up a security package. So in that context, you can then put the cherry on top of your investment paper to say, I think we should, or your credit paper to say, I think we should participate in the debt and not in the bonds, because the value of that security package presents us with the best deal possible in lending to the company. You could even then say, we ran the models, we ran the bond ratings, and if the bonds were to be secured, they would be trading at a yield of 3.5%, but we're coming in at 4% on this debt. So we're actually scooping an extra 50 basis points there. So we're actually doing ourselves a favor by being in the debt and not being in the bond. Okay. So this point, if you can get this right, what are some alternative financial instruments issued by the same company or alternative instruments in the market? So gold is the hot topic, and I'll probably do a webinar just on the gold market because everybody's saying invest in gold. Why? Because, as you know, the Fed is printing cash on a daily basis, and the Fed revises its inflation calculation. So inflation is not at 2%. If you use the same measure that they used in the 70s and 80s, it's not at 2%. It's significantly higher than that, maybe at 10% level. So the real value of your dollar is going down dramatically with time. But if you were to invest in gold, you can't print more gold. Okay, you can't manipulate it by printing it. So gold is seen as a very safe store of value. So you can either invest, and I left this question in the LinkedIn group. I didn't get any responses. The group is still small. But if you join the group, please comment. This will be the topic of a subsequent webinar as to whether you believe it's best to invest in gold, physical gold as an exchange traded fund or ETF. So it's paper gold. The company issuing the ETF doesn't actually own the physical gold. They just have some sort of a financial instrument that is linked to gold. Okay. Or maybe they do have the gold, but they've borrowed gold from somebody and they have to give it back. So when you buy the ETF, you don't actually own the physical gold. You're just chasing the yield of gold over time. So you can either invest in physical gold, you can invest in gold ETFs, or you can invest in mining companies that mine gold. And there's some nuances with all three. So that is your opportunity cost there. So we can do like a mock investment thesis in the next webinar. And please, I encourage you, join the LinkedIn group, leave some of your comments. I'd like to see what you think. And then I will collate some of the most interesting voices in the industry that are saying you should own ETFs. No, you should own physical gold. No, you should own gold companies. So that just answers this last question, the opportunity cost. Okay, so that's the cherry on top. If you can answer all four of these, then you'll be a superstar analyst in your team, or yeah, you'll do very well, especially if you can do the last two bullet points, because typically there's a saying, you don't see the wood for the trees. And especially when I was starting out in my career, I was just really concerned with getting the numbers right. But as I got more experience, then you take a bird's eye view, especially if now somebody else is crunching the numbers for you, then you can take a more bird's eye view and you can see trends and you can see context. So I highly recommend these 4 tips if you are a credit analyst or investment analyst. Okay. The final thing that we're going to do, because I promised it, again, this is a topic of a webinar all by itself, is deal structuring. Now, this is primarily in the context of debt. So these are very simplified organizational charts. Typically, mining companies have 100 of these companies in various jurisdictions, and they do that for a whole host of reasons, some ethical and some maybe not so ethical. But let's just look at a hypothetical example of a company that borrowed a certain amount of money and they wanted to refinance this transaction. So they already have the money, they just want to change the structure of the debt. Okay, so which structure is better for whom? Okay, so this is the first structure. You had the lenders at the bottom giving 1.5 billion in debt to this ABC project company. This project company is the company, pardon me, the company that's actually generating the cash flow. This is the company that owns all the assets, the mine, everything is housed in this yellow square at the bottom there. So the senior lenders put their money there, and they don't put their money at the finance corporation that owns this group company. They choose to put their money directly where the assets are located. So you can see up along the chain, this project company is owned by a finance company, and in turn, the finance company is owned by the listed parent company. So just in deal structuring, the general idea, okay, before we do that, let's look at the new structure. So the new structure, the senior lenders now lend to this finance corporation, which owns the project company. Okay. And they are one step above where they used to be. Now, optically, one would think this is better, because if they lend at the African Finance Corporation level, they benefit from African Finance Corporation owning other assets as well. So they're benefiting, they're lending to a bigger company. And they do even better if they lend the money at listed company level, because then you own the entire group. I learned this lesson the hard way. This is not the way to do it. You want to lend as close as possible to the project company. Why that is you will get a surprise when you take security over these assets and you are lending your money at the finance company level, which is a step removed. And then this company doesn't pay you your interest and your capital. So you then put the company in business rescue and you then say, okay, we're going to liquidate you because nobody wants to buy this company. You're going to get a very big surprise when you then discover that this company has got unpaid salaries, they've got unpaid suppliers, and they've got so many local creditors on the ground. And because you, even if you are senior lenders, you get paid contractual capital and interest first. Legally, okay, under insolvency law of many jurisdictions, this company needs to pay all of its creditors first at this operating company before it can then send up either shareholder loans through shareholder loans or via dividends, any value of realized security after the fact. So you sell all of the assets. The person who actually has the first bite of the cherry is unpaid workers and your suppliers that are on the ground that have provided services at this project company level. And you can get a rude awakening where you realize that you thought you had $2 billion worth of security, but now this company has got actually $2 billion worth of debt at project company level. So because you're one step higher, one step removed, you're actually entitled to zero. Okay. Whereas in the first structure, maybe after they paid their salaries, there's 1.5 billion worth of security left over, and you can get something. You get the first bite of the cherry because you are in that operating company and you're not far removed. So when you are doing a credit analysis, always bear in mind where you are actually lending the money. And that is the topic of a completely different webinar. So what I'm going to do is I'm going to open for questions, and then I'm going to invite my special guest to unmute. And then we're just going to talk about, for many of my students who are looking to either redo their CVs, their resumes, or they are in university and they want to get into investment banking, she's going to do just a little bit of a talk. I'm just going to ask her a couple of questions there. So any questions quick? Okay. None. Okay, great. Nomvula, let me just give you, I see there's a quick question. Can you keep it short because we only have about half an hour left, Pierre?
Yes. I think I forgot about my question. And anyway, I wanted to find out what are the quick things that you look when you're doing merger and acquisition or JVs, right?
Yeah.
So you're merging two companies or you're doing a merger and acquisition, and they usually do this thing called due diligence. So, what are the quick things, or what are the main things you have to look for when you're doing due diligence, for example, in a merger and acquisition or in a joint venture type of transaction?
Okay, it depends on what stage of development the company is in. So if there are existing cash flows, let me just try and recite this off by heart. Existing cash flows, okay, you look at the quality of the cash flows, you'd need the financial model, okay. Future cash flows, you'd look at how much resource or reserve is actually left in the ground, okay. And what are the company's growth prospects? Synergies, yeah. I don't know if you can actually put a monetary value there. So I wouldn't place much value, but every single bank and M&A firm has its own way of looking at things and they can value synergies. I myself haven't worked in that space. I was not looking at synergies. I was looking at how much is this stuff worth and can we get rid of it to get our money back? So I was in the distressed scenario. So I don't really know how to value synergies that much. And there are a few others, but how I'd start my due diligence, oh, you look at management team as well. I'd start my due diligence just based on historical Are they listed? Do they have, even if they're not listed, they should have audited financials. You look at the numbers, and then if they are operating, and then you look at the quality of the deposit, how much life do they have in future? You can look at the technical studies. If the historical models are based on, maybe the management team was a little bit not that ethical and they high graded the mine, which means they mined all the good stuff first so that they could get their money and get out. And what's left in the ground is actually, it's like if you're going down in the ground, it's easy at first and it gets harder and harder as you go down. So I'd look at that for future cash flow. But to answer your question, the first thing, if it's an operating company, for JV or anything like that, I'd look at what they've done historically. If they're not operating, then you just have to rely on all of the feasibility estimates, technical estimates, and you need to stress the hell out of that model, stress grades, just to build in some safety margin. Okay. That's actually a good question. Why not? Okay. Keep that one as well. Due diligence.
Thank you very much. Thanks.
Okay, maybe we do a webinar just on due diligence. Okay, so let me just introduce our surprise guest today. Her name is Nomvula, and we actually worked together in the same organization. She's got over a decade of experience in financial services, and 9 of those years she spent at arguably the largest investment banking house in Africa. So without further ado, Nomvula, can you tell us a little bit about yourself?
Hi, Perry, and good afternoon, good evening, depending on where you are, to all your guests. My name is Nomvula Buthelezi. I run a human resources consulting company by the name of Zamashanya Consulting. We have a large suite of offerings from a human resources perspective, but I think for today, I'll mention just a few, which is talent attraction and acquisition, which is commonly known as recruitment, learning and development, which is also commonly known as training, and talent management. Talent management encompasses the full life cycle of an employee from the time they are onboarded into an organization, they develop, they go through succession for leadership, perhaps, and they exit.
Okay. That's super interesting. I think one of the questions that we get asked most often, and if you just look at Google FAQs, how much do investment bankers earn? Can you shed some light on that?
I think that's a question common in all countries across professions, but salaries are really dependent on what country you're working in, what the scope of the role is, how complex the role is, the level of education and experience you have, the amount of capability and ability you've shown in your career. So yeah, the premium depends really also on the type of organization you're going into. Traditionally, your investment banking organizations tend to be quite lucrative in how they remunerate their employees. But if we're looking at college salaries, if you're joining an organization as a graduate, those salaries tend to be standardized. And the same goes for non-experienced professionals. And the more experience you tally up, and the more exposure you have in different markets, you are quite likely going to be able to command a salary that is favorable to you, your lifestyle, and your needs.
Mm. And just to chip in something, what you'll see is you'll see a discrepancy depending on what role you have. So if you are, there is three major classifications. You have front office, middle office, and back office. So front office is typically people who are in the client's eyes and they are generating revenue. They're in front of the client. So those are your deal makers. Those are even your traders to a certain extent. Those are your front office roles. And if you're directly involved in generating money for the bank, you're in front office. Middle office is more the technical people, the enablers that ensure that risk and company policy is followed. So basically you have your analysts there that if a bank has got a mandate that they can't invest in high risk projects, your analyst has got to analyze the risk to make sure that that company policy is followed. So those are your more numerical, your quantitative, you have your quant analysts there, and those are your enablers. They actually enable the business to run, because without them, it's all in well getting a sale, but if you have no way to make sure that it's a good deal or a bad deal, then and then you have your back office role, which is mainly systems orientated, and those are your IT infrastructure, and again, more of the backbone of the organization. So wherever you fit in, depending on whether you're front, middle, or back office, your structure of your salary, just in terms of the difference between your base salary, what is guaranteed, and what is a bonus. Nomvula, can you just talk us through a little bit about that, perhaps?
So generally, what goes into calculating a salary is your education. So what kind of qualifications do you hold? It also, the next consideration is your experience. The very next thing also is the level of risk that you assume. So you spoke about people being in front office, your deal makers. Those people generally assume quite a lot of risk in terms of acquisition of the client and bringing in the deals. So they tend to be treated really well when it comes to remuneration. Your middle office, yeah, your middle office employees age up in terms of their remuneration. The more experienced they are, the more specialized their skill is, they are able to command salary. And that goes for your support staff as well. You mentioned infrastructure and IT, etc. That also is largely based on your qualification and your experience.
Okay, that's super helpful. And then,
sorry, I just realized we were speaking now about your basic salary. In terms of variable pay or bonuses, that is decided mostly by the performance of the organization. So if the organization has pulled in really good numbers in that particular financial year, the value of bonuses is a lot more inflated than in poorer years. And also it's your senior management who kind of get the cream at the top, and then the rest of us come in a sliding scale. But the same principle applies. The more risk you assume, the more business you bring into the organization, the better your bonus will look.
True. And just one more question. Another commonly asked question, especially on Google FAQs, is what is the best qualification to have if you want to have a career in investment banking?
So generally, in investment banking, they're looking for people who are numerically astute. So your physics, statistics, actuarial science, your financial mathematics students are the ones that are brought in droves. Also, the level at which you studied. So if you just have an undergrad, it's more preferable for you to actually go on and do your master, not your master, but your honors. You can continue on elevating your qualification while in employment, but for entry level in investment banking generally, when they look at candidates and their qualifications, they tend to attract candidates that have completed their honors level. One of the other things is that in South Africa, unlike Europe and the North American markets, candidates with a PhD level qualification don't necessarily look like the best candidate to choose. So we generally do tend to go for your honors graduates because we're able to skill them up and build them up. And part of the total remuneration package, when it's calculated from an HR perspective, is if we fund you for continuous development from a qualification perspective, and we help you get your master's and your PhD, we build it in as a total reward. So we have something called a total reward statement. So we show the value of investment from the organization towards the employee. Yeah, so candidates are typically hired based on their talent, their capacity to learn quickly, and how well they fit in the team. And yeah, that's generally how it plays out in the investment banking sector here in South Africa.
And just another thing you mentioned, the European and North American markets. From dealing with banks in Europe and North America, what I see is the structure of the deal team is often different, where they would hire specialists to do one role. So you'd have somebody in the team who just does financial models, and because of that, they'd probably need a PhD in quants or mathematical finance because they're hired as a specialist. And you have somebody else who's hired as a specialist in the analysis field, and they would need either a background in accounting or something equivalent like an MBA. So what I have found is my colleagues have tended to be more university qualified, but in South Africa, why not much emphasis is placed past your honors. For us, an honors is your 4th year of study. So basically you have an undergrad, which is a bachelor's degree, which is year 3, and then you have your honors year. So honors, unlike the States, honors means you get good grades. No, in South Africa, honors just means it's your 4th year. So with a 4-year degree in South Africa, you'd come into a team and you'd probably be more flexible. So you do modeling, and then on the other deal, you do some more analysis. And then on the other deal, you'd be preparing the pitch books or the PowerPoint presentations. So I don't actually know why that is the case. Personally, I think it's just a difference because it's not necessarily a measure of sophistication of the financial markets. I think with this globalized world, we're all more or less on par, basically, because the world has become more of one place. So it's just the way that things are run in South African banks, where you can come in with a lower qualification and you'll be more of a jack of all trades than a specialist in the US market. So that's just to agree with your point there, that the PhDs maybe not as much value in the South African context, but maybe in the European and the North American context, where they want the specialist, it would be more of an issue.
Yeah.
Any closing thoughts? We've got about 10 minutes to go. I know we were planning on having a full webinar on this specific topic, so we will have you back on. But any final thoughts?
Yeah, I just wanted to bring context just for your guests who may be pursuing their PhDs and more higher level qualifications. It's not that the industry doesn't really like higher level education. It's just that in our market, there tends to be a strong desire to bring in young talent and develop them. and multi-skill them so that they can fit into different types of settings in an organization and move around quite easily. So it's more of a developmental approach, but the more seasoned and senior you become, definitely you command more more experience. You are given more specialized projects to work on. The expectation is that your qualifications also match that. So, like I said before, in our market, we tend to want to help to facilitate that growth. Most of the corporates in South Africa have a bursary funding program for their employees. So you would or honors level, and you would apply for an internal bursary, and they would fund your education all the way up if you so choose.
Okay. No, thanks, Nomvula. Great insights there. And in the LinkedIn group, we'll just be sharing some links to your organization if people want to check out what you do. Just again, for some housekeeping, for future webinars, if you want to be kept in the loop, I will send out email to whoever emailed me for this event. From now on in, we'll do it via email. It's a lot easier to communicate than via the LinkedIn group. So on the email, I will send you some useful links, one of which is a link to the LinkedIn group. And on the LinkedIn group, I post interesting insights, resources, and most importantly, a recording of these webinars. I upload it and I put it on the LinkedIn group. So I encourage you to join it. And let's grow the community, ask questions, and where I can't answer the question, I will invite a guest and they will help you with your questions. Yeah, thank you guys for joining. We've got about 8 minutes left. If anybody wants to ask any final questions, now would be a good time to do that.